Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining us on the Nasdaq Market Site desk, we have Jonathan Silver, CEO of Affinity Solutions, as well as Phil Mackintosh, chief economist at Nasdaq. We also have Max Cabasso, director on Nasdaq's Market Intelligence desk. We're going to take a look at the strength of the consumer outside of traditional economic metrics. Gentlemen, it's great to see you as always. Welcome back to Trade Talks. And Jonathan, I want to kick it off with you. It seems as if we're coming to a point where we're questioning the types of data sets that the Fed and other organizations are dependent on, because perhaps it's not a one-size-fits-all picture for all consumers.
Right. So first, just to level set, our data is from 140 million consumers. We receive that data almost in real time from thousands of banks. It's 9 billion transactions a year. It's over $500 billion of spend. And the one thing I can say, the headline is that the American consumer is very adaptable. February was up 4.4% year over year, over 1% month over month. So despite inflation, despite rising interest rates, global unrest, we're seeing pretty good adaptability. And one particular segment that's worth highlighting is non-store retail. So e-commerce, Amazon and others that are predominantly e-commerce, up 18% year over year in February. We saw that fairly consistent throughout 2023 at 27% year over year. Some of that could have some headwinds as retailers are starting to charge for returns. So we're seeing a little bit more resistance to free returns or no hassle returns. So that could affect as we look forward.
Well, Phil, it's interesting. Max and I were talking about this on the desk earlier this morning with affordability. When you think about the housing market and the lack of supply, people have these big chunks of money that they're waiting for a down payment. Either they're priced out or they can't afford the mortgage payment. Do you think that some of that capital is being allocated to experiences or to consumer discretionary shopping?
I mean, it's one of the weird questions right now, isn't it? Because we've been out of COVID now for a long time. All the data that looks at the savings rate shows that people should have spent down their COVID savings. Why is the consumer still so strong? And it's been really interesting to think about the different theories about it. One of the theories is because everybody's locked in a 30-year fixed mortgage, then they've got all that extra money to spend because the mortgage rates haven't gone up. But we have started to see increase in spending on credit cards, even some increase in delinquencies on credit cards, but that hasn't slowed down the spending rates. So one of the things that other people are talking about is the fact that we actually have growth in real wages right now. So despite the fact that we've got a little bit of an uptick in the unemployment rate, we've seen a softening generally of the labor data, we haven't seen layoffs. So I think the worker is still really confident. They're starting to see more money in their pocket, and that's starting to replace what we had before, which was all the stimmy spending.
Right. And Max, another thing we were talking about regarding the housing market and the consumer is, especially for people who are looking to downsize, if they're downsizing and they're competing with first-time home buyers looking for smaller, more affordable homes, by the time all the bidding is done, you can't get there.
Right. That affordable price that you were looking at is now elevated and higher because, again, the competition's out there, limited supply. So again, you're competing, like you said, somebody downsizing from their house, some of the boomer generation selling, downsizing, and you have a millennial looking to buy. I'm desperate to get into this house. Bidding starts to go up, and then that affordability goes down. And like you said, with rates kind of still where they are, it's still an expensive house. So, kind of piggybacking what we were talking about before, is that spending going into the market? Is it going into crypto? It just. Mm-hmm. You're sitting there trying to save up this down payment, and you're kind of struggling. Okay, when am I going to get this to put this to work? And it's kind of just sitting there, and with inflation still, according to the CPI, still about 4%, 3.5%, basically losing money, just sitting there. Okay, let's put it to work somewhere. Are we going to spend on experiences, or into the market? Is that helping kind of keep stocks where they are? There's a bit more of competition there. Like you said, just cash is sitting there for people, and kind of where are they going to put it to work, because otherwise it's sitting there and not growing.
I'm sorry.
A lot of the inflation, though, that's being held up still is from the housing, so it's coming through the rent side. Yeah. So I think a lot of people are giving up on buying a house and just going into the rental market and holding that part up, because probably 2/3 of the remaining inflation is just the housing sector and the rents. Yeah. So when that starts to come down, we'll see CPI come down even more.
Yeah, there's also excess savings. If you look at what's in people's checking and savings accounts now versus pre-pandemic, it's $2 trillion more than there was pre-pandemic. So I think people are feeling pretty flush, and I think that's a big factor as well. We used to look at the consumer sentiment as an indicator of what consumers are going to do, and we're finding since the pandemic it's counterintuitive. You can't really rely on that. So what can you rely on? It's what you said: wage growth, inflation, interest. But the money in the checking and savings accounts, I think, is a big factor as well.
How does the data that you're seeing in Infinity different than the traditional data sets, let's say, that the Fed relies on?
So most of the consulting firms use our data from Affinity Solutions, 200 investment firms, and the reason is that the Fed data, which a lot of the data comes from the census data, is every month we can slice and dice it by age, income, And one thing that we saw in 2023 and 2022 is that the increased spend among low-income consumers under 50 to 75K a year was at a higher rate than middle and upper income. And that's a sign of a healthy economy because half of total consumer spending is lower income. So we're encouraged, but we have been encouraged by that. In February, they're exceeding the spend overall, the average, by a full 1%.
Yeah. Phil, would you say that the metrics that the Fed relies on, either the methodology is outdated or they're looking at it perhaps not in the best perspective because it isn't broken down into more distinct segments?
I mean, they may have more granular data than we all see them seeing, but I think maybe at the moment the Fed might be giving themselves a bit too much credit for having pulled inflation down. I mean, ironically, if the mortgage rates haven't changed people's spending behavior because they haven't gone up, you look at the corporates, a lot of corporates look like they locked in fixed term debt during the zero interest rate period too. So interest rates have gone up for a relatively small piece of the economy. It hasn't really slowed spending down. And I think that's what we're seeing in the spending data and why the US economy is just doing so much better than everywhere else in the world. The spending is still coming through. And it's possibly because all the inflation data was transient. It was energy, and energy translated into food with fertilizer prices. It was the shortages way early on in COVID, which are now all, supply chain shortages are all resolved. So maybe it was transient. It just wasn't as shortly transient as we first thought.
Yeah, it's almost like you question yourself, what's it going to take to get it back to some sort of normalcy, right?
Well, the PCE is below 3% now, and if you look historically, that's pretty close to where the Fed wants it. I think if they really hold out for a 2% number, like a 2 or less, they might be waiting a long time, and they might actually cut their nose off to spite their face, because we're already seeing a big spike in interest expense coming through the consumer side, because some people are buying houses now, and interest rates and credit card usage is going up. And so there's a risk that happens. There's also a risk with commercial real estate as people start to refinance buildings. As they refinance at higher interest rates, that's going to make those buildings less profitable. So if we don't pull the interest rates down, at least to something a bit more normal, because right now we've got 5.5 rates, sub 3 inflation. That's a strong positive interest rate. That's pretty restrictive from a monetary policy point of view. So if we could come down a lot and still not be loose monetary policy.
Yeah. Max, let's pull up a couple charts here and see how the market is reacting to the macro here. Let's start with the S&P versus the S&P equal weight. We're starting to see a little bit of shift here and the breadth widen out a bit.
Yeah, I included IWM in here for the Russell 2000 actually, just because of how similar it's been to the S&P equal weight. If we go back, I'll show another chart in a second here, 6 months or a year to date, broader S&P was wildly outperforming the S&P equal weight. And as we all know, the Russell 2000 was getting, really beaten up compared to the S&P. We're starting to see that change, and some of the, kind of the Mag 7 have started to kind of roll over a bit. So now we're starting to see breadth start to widen out. It was really picking up, and again, this is a 1 month chart here, so you can see it's outperforming out over the month. And now if you go back and if you look at the 1 year here, there's a big dispersion here. So obviously the S&P was really outperforming. We're starting to see that gap close a bit. Today's kind of going back the other way, but it started to close. We're starting to see more people participate, more companies, get a bit of a tailwind here. As some of that large cap was really concentrated, there's a lot of heavy positions there. So as those start to roll over, starting to see a bit more breadth pick up, and some others start to pick up to the upside. Whereas again, for the last year, it was really the story of Mag 7, and that was kind of the only thing keeping the market up. Starting to see it pick up a bit now for some of the others here. Again, but if you look at here, S&P equal weight, the Russell 2000, something I haven't really looked at. They really tracked each other, quite closely. As we always talked about how the small caps are underperforming, small caps. When you look at the equal weight here, it really is tracking pretty closely to the Russell, equal weight versus Russell. And you can see over the year, they're both at about 18, just over 18%, whereas the S&P is up, 34%. So again, starting to see that gap close, but it really highlights just how much the performance has been a few of the large cap or mega cap stocks that really kind of carried the weight.
Right, and outside of the Mag 7, of course, Costco, which is one of the surprises, at least in the Nasdaq 100. We're going to get into XRT in just a moment here, but that goes back to consumer healthy spend. Let's pull up a chart of the XRT, which is a retail-themed ETF.
Yeah, we're finally breaking out here, essentially over the last 2 years. The peak was just below 80 back in March of 22. Had basically, a failed attempt in August of 22. We peaked, sold off, did it again in February of 23. We finally got the breakout here, again, peaking back on the early 2022 levels. giving back some of the gains now. I've seen some selling, but some of the clothing manufacturers, Abercrombie, Gap, Macy's, have really helped here to push it higher. Cooling off a bit after this recent run, but it's a nice looking chart here, finally getting some support. So again, if we can kind of hold just below this 74-ish level, that's a good level to take a shot. And again, it's really been picking up compared to where we were just in October here, down at 56. We're up at $75 now. So it's been a strong run for them. Again, cooling off a bit the last couple of days, kind of consolidating, but now you have some support levels that have been resistance for a number of years now, for basically 2 years. So it's looking like a better setup here.
Right, so it looks like the technicals are confirming what we're thinking fundamentally, and of course what we're seeing in the data. Jonathan, question for you as it relates to Affinity Solutions. Everyone's talking about predictive analysis when it comes to data. Is there anything that you can see with Affinity Solutions that might predict how consumers may behave?
So a couple of things. First of all, seeing a few sectors, listening to you talk about different sectors that are outperforming the rest overall. Just one of them is sporting goods, up a lot, and that's also sporting goods, books, music, things that people care about, self-care, up 14% year over year, unadjusted. Health and wellness up 11%. We saw that trend throughout 2023. People are just focusing more on themselves post-pandemic. Durables, we're starting to see signs of life, so we're talking about appliances and electronics, finally up 1.1%, and then furniture's down. So there's a kind of that trade-off. People are buying appliances, buying new ones and then not buying furniture. So those are sector-specific things. Clothing, you mentioned the clothing retail is up 8% year over year, 0.5% month over month. Food and beverage, interestingly, both are up. We're seeing grocery up, I think it's 5.6%, gotta remember all, 5.3% year over year, and restaurants are up 4.7%. It's a little bit of a head scratcher because you usually see a trade-off between eating out and eating in. So those are the sort of sector-specific things. There's also some policy implications. So we think about the Biden tax proposal. If it gets passed, I think we did some work for the White House and the cabinet with a group out of Harvard, and we showed that the income cutoffs for the stimulus checks, so that's where we were the ones deciding where that should be, under $80,000 a year household income, people would spend the money very quickly. Above $80,000, they put it in the bank. So we're sort of correlating that with other observations to say that, whether you like it or not, if the taxes go up for people above a certain income level, probably not going to affect their spend a whole lot. But if you give tax relief to those under a certain level, it's likely to increase the spend. So those are the kinds of things they're watching out for, depending on whether the tax proposal gets accepted.
I mean, it's one way to keep the economy strong while they're going to an election year.
That's right.
If people are going to continue to spend. Phil, anything that your group is starting to work on as it relates to policy and as we're heading into the elections, or is it still too early? I mean,
I mean, no one knows how the election's going to go this time around, but we have been looking at what happens to markets. And so typically the election year, it's a bit challenging. It's usually challenging right now when we're going through the primaries. Then it picks up a bit, and then it gets challenging right before the election, and then it picks up after the election. With volatility, it's typically a little elevated in the last 2 months before the election, but then it goes back down to normal pretty quickly as well. So we've been looking at message traffic and the sorts of activity that we might see on the stock market, but generally what tends to happen is the economy matters much more than whoever wins the election anyway.
Right. So Max, in the Markets Intelligence Desk, you spend your time talking to Nasdaq issuers, Nasdaq listed companies. Just for some background for the audience, anything that you're hearing as companies are moving into the second quarter of the year, whether it's interest rates, cost of capital, how they're thinking about policy shifts?
Yeah, I think it depends on the sector and the space of the type of company. Is it a capital intensive? Is it some of the hardware companies? Some of the chip companies? Seems like they've kind of cleared out a lot of their issues, kind of cleaned up the balance sheets, and are really looking for a second half acceleration. This past quarter, the one before, they're kind of looking for a bottom, especially the chips. Obviously, we know the Nvidias of the world that are kind of taking off with AI, but a lot of them have kind of been clearing everything out, resetting, getting set for a second half surge. Smaller ones, again, were kind of waiting. Some of them took advantage when we saw that dip in rates, a few months ago. Obviously, it's picked back up, but kind of get some short-term financing, make it through, the next year or two, and then, look, later for something more long-term. But they've seemed to clear out the balance sheets. They're ready to kind of look for that second half acceleration. Is kind of what they're looking at. And the last quarter was really all right, flush everything out, reset the baseline, and now really look to kind of execute as we head into the back half of the year.
All right, and Jonathan, final thoughts here as you're looking through the rest of the year.
Look, as long as wage growth, I think it's at 4.5%, continues to exceed inflation, as we were discussing before, I think the $2 trillion of excess savings in people's checking and savings accounts is going to be a significant backstop. We're looking at probably a 3.5% to 4% outlook in terms of growth for 2024 over 2023, which is in line with the NRF, which is our partner in this process. So we're feeling pretty positive.
All right, gentlemen, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.